Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts.
We're super lucky to have Pete Flint, a general partner at NFX and a former founder and CEO of Trulia. We have our on-deck angels here, Pete, coming in. It's a group of angel investors, some experienced, some emerging, all different types of sectors and categories and from all over the world, except maybe some of our European ones might be asleep by now. Pete, it's great to have you. Maybe by way of introduction, maybe I can ask you to introduce yourself a little bit, and particularly how you transitioned from a founder to a full-time investor, because some people here are looking to make that same switch or evaluating whether they should make that same switch. So maybe we could start there as entry point. First, thank you, Pete, for joining us today. And we'd love to. Why don't we start with your background there?
Cool. Yeah. Well, good to be here. Good to see you, Erik, and the gang. So I guess my quick background is that you might detect I was born in England, so lived in the UK to my late 20s. And I previously worked as part of the founding team of a company called lastminute.com, big online Web 1.0 online travel company that was just super successful and interesting at the time. And I moved to the US to do an MBA at Stanford. And while I was there, I actually took I did a summer internship at Battery Ventures, because I was always sort of once you're in sort of entrepreneurship, like is either one side or the other side of the table, you have to figure out which side. I'm happy to talk about kind of internships at VC funds. And anyway, I actually didn't have a great time, not a terrible time, but just didn't feel like this is what I wanted to do. But I did, during that time, come up with the idea for Trulia. So basically started that and ran that while I was at school for a decade. And then, after 10 years, the company merged with Zillow, an amazing journey and great experience. And at that point, I was like, okay, what next? And so that sort of thing that I was planning on and sort of the default option, I think, was to get into venture, but I wasn't sure. I think, you kind of come out of that, of a very successful entrepreneurial experience. And, it's actually a huge change while you're kind of hanging around with similar people. And I just wasn't sure it was the right thing. So I ended up taking a year off. I had young kids who were just born. So unlike most people that have an exit, I was not in Bali kite surfing or, doing some exotic things. I was changing diapers and, getting away from getting out the house and meeting entrepreneurs and advising them in SF. And I think that point, it was more just I guess what I was concerned about was this kind of flip from managing over 1,000 people to managing like literally no one. And I was very sort of like cognizant of this flip. And so really I just spent a year just trying to like angel invest, speaking to different folks, seeing whether I actually wanted to do this. Cause I think you can overcorrect sometimes, because at the end it was quite a tough experience, having to combine two companies and FTC reviews and all the rest of it. And so anyway, I during that year, I kind of hung around a lot of venture firms and a lot of startups, and just kind of realized that what was interesting to me was certainly investing at the early stage, where I had as a founder myself, had a unique kind of perspective. But I think most of all, really thinking about what am I optimizing for? I think for folks kind of figuring out, like, there's many different flavors of investing, whether that's angel investing, whether that's being a venture partner, whether that's being a general partner, being starting a firm, joining a firm. There's all different flavors. And I think for me, it was really two things: optimizing for the people that I work with, and then recognizing that I'd had this fortune of being a builder and building something and wanting to build something again, not necessarily to be slotted into like, okay, you are the consumer marketplaces guy at Series A. That's your thing. I kind of wanted to get involved in all sorts of things, building the marketing, building the content, building the culture. So that, then I teamed up with James and Gigi and, helped to turn NFX at the time, which more of a sort of boutique, two-person accelerator kind of into NFX. So that was the journey.
That's awesome. And yeah, you guys have created a real platform with all the content and all the product stuff. It's really impressive. How did you sort of think about developing your frameworks as an investor? You'd been on the operating side for so long. What have you sort of picked up in terms of frameworks, whether it's you're evaluating founders or evaluating ideas that you think either are unique to you or just have served you very well that you advise other emerging investors?
I guess as I think about, that transition from operator to investor, I think one of the mistakes that I made early on was being overly focused on the idea and overly focused on the strategy. And, an example is that I'd invest in a company which, you go through the deck and like, wow, these guys are awesome. They've this is very clever. And this is a huge market. This is spot on. And, literally kind of investing off a deck as an angel investor. And then you sort of spend time with it. You realize that this team is just unable to execute, perhaps, generalizing, but perhaps they're just super smart ex-McKinsey consultants that can know how to sort of strategize and present, but just when it comes to hiring, when it comes to execution, just they've not done it. And so I think in a way I was because I kind of knew how to execute, I sort of felt the execution piece was easy. It's the kind of strategy and idea and sort of the clever hack that they would use to get scale. So I've kind of very much gone the other way, which is the team is everything, and sort of almost downplay the kind of strategy, because most folks have been around the sort of investment community for long, realizing that the first idea is rarely the kind of the actual idea. And so things you necessarily need to change, but the right team that can execute to get from kind of A to B, not necessarily A to Z, but A to B, figure out the right path to get to the destination. So that's one. So just a kind of focus on sort of team beat strategy, which I think is something that former operators need to be very, very aware of, because they have that biases. The other piece from my perspective, I spent my kind of career, the first bit in Europe was essentially the kind of head of growth for lastminute.com. Although it wasn't called that was essentially my job, was to get demand side growth. And then at Trulia, I was beyond being a CEO, I was sort of the chief product officer and chief growth officer. Those were kind of my evenings and weekends. And so I'm very much distribution focused. So how are you going to get, the go-to-market distribution? That's really and that's met a company today, great team, great idea, great market, but just didn't have the go-to-market, the growth mechanic. And so much, NFX does invest in a lot of marketplaces, and you just need to have often this sort of clever supply or demand side, ideally both, to get you that initial scale, that initial traction, because things are so competitive. If you don't have that insight or that novel go-to-market, then it just becomes extremely hard.
Yeah. For companies that do have one, but you don't agree with where they go to market, what is the biggest mistake you think founders make when making a go-to-market plan around, whether it's around marketplaces or something else? Or is there a certain framework that you particularly like, and advise your companies?
Well, I think there's a lot written about it, but I think the mistake that often early stage founders make is that they try to have a portfolio of growth channels. And this is sort of counterintuitive. The idea is okay, I can't be dependent on one thing. I have to have this range of different growth channels to acquire consumers or to acquire the supply side. And realistically, the world is so competitive and there is such a power law on these things, and you have limited focus on what you can do. Often it's better to just do one thing extremely, extremely well. And you see founders we're doing some SEO here, we're doing some email here, we're doing some social here. We're no, just it's okay to experiment for a bit, and then you just got to pick one and put 80% of your resources on that channel, because then you can start to become not just good at that, literally world class at that, and beat out the kind of the other folks that might be focusing on those channels. And you see, the power law, whether it's in social, where kind of like the top 1% in Instagram is just way beyond the kind of like the top 10%. Similarly, if you're trying to focus on SEO or you're trying to focus on referral mechanics, like this stuff has compounding returns. So that's the, sure, when you raise a Series B and Series C, you start to kind of layer on these channels. But you have to pick one, and you have to be like world class, literally world class at that channel. If you are there, then it will give you the opportunity to kind of go into other channels. The challenge obviously is just, you don't necessarily know which channel. And so that's the insight. That's the genius. That's finding the person they hit it. They figured out that this is the growth channel for this product at this time. That's the rarity that we were looking for.
Totally. I want to be including some of the questions that the audience is asking. We'll make this interactive. Would you like to ask your question?
Pete, thanks for being with us. Pleasure to meet you. Super helpful. Wanted to ask a little bit. You mentioned earlier that you really enjoyed building, and you were optimizing originally for building, working with the people around you, and that you really enjoyed getting into things like learning a little bit of the marketing, building a little bit of the culture. I find myself sort of like having very similar sentiments, and something I observe about myself, is that I'm maybe like getting blocked because I want to learn the thing that I know I could be possibly like hired to do. So I was just wondering if you could kind of talk through like how you went about filling in the gaps of your knowledge. Was it just because you really loved that thing and wanted to learn it, versus like hired for? And then how you kind of thought about investing as like a piece of that puzzle?
Well, I guess, on the building side of things, I think part of it is just, my own, I've been a CEO for a decade. And so, and I often think that being a founder is just literally the most privileged position you can have. It's a ton of hard work. It's, sleepless nights, all the rest of it. But you end up getting to choose the people you work with and choose the environment you work in. And if you're successful, you get to choose the problems that you work on. And that's just, you never get that. Like, it's just think about kind of corporate America or the Uber drivers or like that. That's just like totally like incredible good fortune. That was really a little bit of kind of what the calculus was going on in my head, that I wanted to kind of build stuff and be part of that journey from the day one, not have to earn that so much. So that was the thinking. I guess in terms of like learning different stuff, and I think I'd been obviously like through my entrepreneurial experiences, I touched every piece of the organization. And so I guess I'd kind of, I sort of had the background of kind of learning through time. And, I think you learn, and I would say I wouldn't have a single kind of methodology to learn, but I think I learned best by doing, learning from people, but actually just plunging in and doing it and not trying to make mistakes along the way. But, I guess if I was to kind of think about the new skill that I've learned specifically in the last couple of years, which has been more, and investing, I think is not easy, but it's like, I think there's a sort of, if you see enough companies and you speak to enough people, you kind of, you can get good at it. I think the big sort of unwritten thing about kind of venture is the transition from being an investor to being a fund manager, which is totally different. It's like a financial kind of management. And I think the process of learning sort of the back end of venture capital has really been informed by just speaking to a lot of other VCs, speaking to a lot of like limited partners. And it's just like connecting with people. And that's just clearly one of the sort of magical things about our ecosystem, that we're able to connect with other people and they're able to share different perspectives and give advice. So I'm also kind of a big reader, probably more compared to some of the other folks on this, naming no names. I'm more of a kind of lurker than active tweeter, but like I'm a voracious reader. So, hundreds of newsletters, can come into my inbox every week. And I'm just consuming all that information the whole time. And I've been doing that literally since I was 20, like getting all this stuff coming in, and then maybe it's sort of skimming everything. That's been my method of learning primarily.
That's helpful. Thanks, Pete.
Pete, so you spent a lot of time, obviously as a builder in real estate, but also as an investor in real estate tech more broadly. I'm curious if you can give an overview a bit of how the space has evolved, maybe the different phases or waves as you see in the space, and then what's your broader thesis right now in terms of with the type of stuff that you're interested in and the type of stuff that you're not interested in.
Yeah. So I guess so PropTech kind of specifically, firstly, I think this is, I've been sort of astounded at how big a category it's become, like since I was interested in it first 15 years ago. But the backdrop is it's probably not that surprising when you think about real estate as the largest asset class in the US. And you start to see, while it was sort of mum and pop kind of back in the day, it's like you've seen just massive institutional demand for this asset class, particularly post 2008, where you've just seen a lot of institutional asset managers just making fortunes, not overnight, literally, but kind of soon after in going long real estate from that. And they built up this kind of massive exposure to real estate. And the thing about these big asset managers, they want to continue that. So you've got very strong kind of equity returns, as well as strong kind of more kind of fixed income and sort of more lower risk returns from Wall Street. So this is just this massive asset class. And then from how sort of PropTech and real estate as an online investment category has evolved, I kind of think of it in three different buckets, all of which are interesting. One is residential, like changing the way that real estate is transacted. Second piece is the sort of leasing, whether that's residential or commercial. And the third piece is the spend around the home, whether that's construction and maintenance and smart homes and so forth. So maybe just take those three pieces. So firstly, on the kind of transactional side of things, residential, or you could say commercial as well. But, I'd say that there's really two primary phases we've been in. So the first phase, which I think of as sort of real estate 1.0, which was like 2005 to 2015, was really solving the information problem. So if you think of Trulia and Zillow and to some extent Redfin, which were really just pioneering, taking this information that was locked up behind agents and expose that to consumers. And, a lot of war stories about showing kind of historical transaction data, all the listing data that, we really, Trulia and Zillow and others kind of just broke that database free and exposed that to consumers and monetized primarily through advertising. The next phase is, real estate 2.0, which is post 2015, which is really solving the transaction problem. And anyone that's kind of bought or sold real estate knows that it's just horrible, it's expensive, it's time consuming, it's confusing, it's uncertain, and now that's starting to be transformed. So probably the kind of, the pioneering company there is Open Door, the folks have heard of, which helping to solve the way that consumers sell their home primarily. And obviously there are sort of other flavors of that, where they're solving the mortgage problem or the title problem, but they're really trying to take this multi-month, highly uncertain, highly expensive, highly confusing process into a kind of, as simple as booking a restaurant or booking a hotel. So that, and there's this is such a massive industry that real estate commissions are approaching $100 billion. And it's kind of lame, right? But anyone that's bought or sold knows this big opportunity. So that's one clear piece, which I don't think there's going to be a winner take all. And it's very much, people will look for different service providers with different product value propositions. That's one piece. So the other piece is on the leasing side of things. So, commercial or residential. On the residential piece, for many people that are certainly homeowners, the rental check that you spend every single month is the single biggest expense item you have. And it's still incredibly antiquated. There are obviously there's folks like Sonder and Zeus and Casa, and others, which are kind of helping to improve that. But it's still massive industry and very fragmented. So I see a bunch of opportunities there. And then on the commercial side as well, I look at NFX's expenses, and like, other than salaries, it's real estate. That's the single biggest expense. And that, that's going to change as well. Where these companies are changing, and maybe this is the 2.0 there, is that they're kind of, I think a lot of companies got really greedy. WeWork in particular, which were they're going to let's kind of buy buildings or long-term leases, or let's build buildings. And like, they're realizing that could work. But you don't generate software type margins, and you have incredible downside exposure to incredibly cyclical industry. And so those, whether you're renting, or, for residential purposes, or for commercial purposes, flexible leases, often low risk leases, or lower risk leases is probably where that's going. Master leasing stuff, and then working with tenants is where that industry is evolving. And I think they're going to be, particularly in what we're seeing in sort of real estate now, this, whether you're buying or renting, just this like widespread shift in demand when very static supply. So there's a bunch of opportunities for companies to come out of that. And some will do extremely well. And then the third piece is just the spend around the home, where that's construction. It's $1 trillion construction industry. Again, it's incredibly antiquated. And there's going to be a whole range of different companies that do very well there, whether that's, from the workflow automation or VR to kind of manage the sites, whether it's labor improvements in the way that labor is done, whether it's supply chain innovation that improves the way that materials get there, whether that's smart homes, like figuring out how to optimize the spend. All these things are seemingly incremental and seemingly niche, but when you combine them in this massive market, you can individually build extremely big industries. So that's a kind of like a short kind of update on kind of what's going on in PropTech.
What do you think about the companies that are trying to fractionalize real estate in a bunch of different ways? Is there anything that you've seen there that's particularly been interesting, or what about just that trend in general?
I think it's directionally interesting. I think there's, like, from a consumer's perspective, there's definitely an appetite to, just like in the same way Robinhood is just like lowered the friction, increased the usability, and open up that market. I think there's probably similar opportunities in real estate investing. And that, when you sort of look at the sort of long-term returns of investing, it can be extremely attractive. There's a lot of regulation to overcome. There's also a lot of psychology. Most consumers' single biggest asset is the home. And, they should be diversifying that. But there's, a bunch of anxiety about that. People don't want to diversify because they're worried about there's not enough trust in the system. And then also the US mortgage industry is backed by the government and Freddie and Fannie. And that's just like, it's very hard for private companies to compete against that. So, you've got this very stable kind of capital source. You try to compete against this sort of, the US mortgage business. You're competing with the government in some respects. So how can you, but there's something there. I don't know exactly what it is. There's a few companies that kind of we speak to, but I think direction is interesting.
Yeah. Well, let's zoom out into broader investing questions. Juliana, would you like to ask yours?
Yeah. My question was, how do you you talked about strategy, people beating strategy kind of every single time, and teams beating strategy, and certainly been my experience having been in corporate. What qualities do you look for in a team, and how do you assure yourself that the team can execute and scale?
What comes to mind is just an idea, a sense of their ability to be exceptional in what they do. So, whether that's academic, and the thing is really trying to find proxies for that, whether they have been sort of exceptionally academically, whether they've been exceptional in athletics, whether they've been exceptional in kind of coming from one environment and, when perhaps they didn't have the kind of fortune of, like myself, of kind of a very stable middle-class household, of coming out and being extremely successful. So I think there's just this, like, are they kind of, do they have, and that comes down to often sort of raw intelligence, but also drive and persistence. 2 is the level of insight this person has on the market. and that rare insight, which is, partly skill and partly luck to figure out what it is. How do you tackle this market? The ability to sell and recruit people. We've looked at many companies and, sometimes, particularly on the capital intensive companies, we pass because we just don't think the team can raise the necessary capital to achieve what they need to achieve. And it sounds kind of terrible, but I think they just don't have the ability to bring people onto the ride. But if they're not able to raise capital, they're probably not able to recruit people. It doesn't matter how good the product is. If they're not able to kind of bring people along for the ride and recruit people as well as bring capital, then that's going to be a challenge for them. One off definition I've heard from some people is the entrepreneurship is really an exercise in bringing on resources that you don't own, you don't have access to yourself. And the terrific entrepreneurs are able to marshal these resources, whether that's convincing people to partner with them, whether that's convincing people to open their wallets, whether it's people to convincing them to work for you. That's a kind of rare skill. The other thing, just on this sort of execution piece, one thing that, there's a lot of people who worked at many great companies. I think one of the skills that I've tried to learn is how do you figure out whether someone is, this is sort of crass language, but like, were they driving the train or were they the fly stuck on the windscreen? And you meet, early employees at kind of Google or Pinterest or others, like, figuring that out is critical. And that's, a lot of that's just frankly sort of back channel referencing on individuals, figuring out whether they can, what was their role in this outcome that they're a part of.
Have you ever been surprised at just, you thought that you were making the right call with a team or with founders and it turned out to be not to work out?
Oh, frequently. I think frequently that you,
yeah.
I mean, I think I've got better at it over the years, but I think some of my best investments have been like, I have really no idea about this idea, but you are awesome. And so I'll back you and go and figure it out. And they, surprise. And then on the sort of, on the flip side, there's people that are incredibly pedigreed and incredibly sort of accomplished on the resume, but don't have the kind of fortitude to figure things out.
So that's on the founder side. How do you? So we have a bunch of angels here who are investing in both seed and Series A. How do you sort of think about certain metrics or certain benchmarks that you're looking for at each stage? Obviously, it's company specific, but even just broad strokes, just in terms of frameworks for thinking about, hey, this is a good Series A bet. This is the risk I'm okay taking. This is not the risk. This is too much risk, or not the kind of risk that I'm okay taking. How do you think about that?
Yeah. I mean, I guess sort of break it down at the seed stage. There are many seed funds or seed-backed companies that raise capital just after a business plan. Business plan not in the traditional kind of 20-page Word doc, but just as sort of an idea. The basic sort of question on the team side does this team have a unique insight about how to solve this problem, and do they have the ability to scale this organization, this small idea, into a huge company? And, often that, we do try and look for some elements of complete teams, not 100% complete teams, but relatively complete teams. So the team is obviously the most important. And, in talking to Juliana and the group, there's some sort of perspective there. Again, on the seed side, the market selection is critical. We've seen many good founders fail in bad markets, and, market selection that is both penetrable, but also able to deliver venture scale returns being critical. And then obviously figuring out the right timing. And then as we talked about, distribution is critical. So seed stage, I wouldn't say there's really any metrics around that. And sometimes no metrics is better than if you're ticking a lot of boxes, then like actually having no metrics is better. It's easier because there's no data to disappoint. At the Series A, the stuff that's, the number one thing is clearly traction, and combined with that, product market fit. So I would say it's hard to kind of ascertain metrics. I would say traditionally, like 100K MRR is sort of getting to the threshold of like, okay, this is Series A ready. Sometimes, depends on the margin structure, but sometimes it's 200, sometimes more, sometimes less. And then for many of the Series A investors, it's the growth rate, which is going to be the primary consideration. And I think related to that, sustainability of the growth rate. So, if you're doing 100K a month, 20% monthly revenue growth, it's like, that's very good. There's a real opportunity there. Within product market fit, it's, I would say this is part art, part science. The science piece is mostly around retention, but, different cohort data, depending on the type of business you're in. Probably the more important thing is to really understand the cohort data of your competitors. Because I think, if you're able to kind of understand, then not only, because one of the things, particularly on the top Series A investor side, is they don't want to back the kind of third best team or the third best company in this category. And you have to demonstrate why you are the best company. And, comparing a sort of food delivery company with a real estate company just doesn't work from a kind of metric perspective. But if you're able to kind of deeply understand the competitive set, understand why you have a unique proposition on the product side and how that translates to superior metrics, and you see why you might be smaller, you have this sort of upside potential, then there's a real opportunity. But I would really, on the metric side, I think it's less about what is the number, but why on the product, on the sort of engagement metrics and the retention metrics, why this is a superior metric vis-a-vis the competitors. And I'm, where you have competitors, as an investor, if you see a founder who is like detailing and dissecting why this particular competitor failed, or why this particular product is insufficient, and do it in a healthy way, I find that extremely impressive. They don't come from a sort of sense of arrogance where, they're going to win no matter what, but they've got a really sort of analytical view about what it takes to be successful and able to back that up with data.
And what are you looking for on you mentioned it depends on sort of the margin structure. What are some frameworks for thinking about margins?
I guess more is better. So I guess I don't really have like a kind of like a very clear margin structure. Like, through the evolution of the internet, we've gone from kind of like pure software to more hybrid. And so you've seen, there's been a way more kind of like, and it's transitioned from kind of high margin kind of media to low margin kind of physical. People opening stores for their kind of online product because it's clearly lower margin and it might make sense. But you've seen this sort of like, as the industry has matured, people have gone to lower margins. And I feel there's been this sort of, not a COVID thing, it's more of a WeWork thing. People have flipped back and just saying, ouch, actually margin is really important, and good margin affords a lot of errors in the business. And so I think there has been a reversion to this. The people, I think, were, there was a time a few years ago where people were more focused on revenue scale. And I think from an investor perspective, that's shifted to like, okay, let's focus on margin. And if we have good margins, then that gives us, we'll be able to navigate in a more volatile world. So I think that's been a big change. Notwithstanding, there's like, the Open Door offering and their kind of investor deck, they talk about low single digit margins and multi-billion-dollar revenue numbers. And so that's an aberration. And I think ultimately that stuff will come down to like, okay, what's the contribution margin for these businesses? And if there's a lesson on that, I think the DoorDash IPO is, they did an extremely good job in detailing kind of like cohorts and margin and contribution margin. And that's somewhat a reaction, I think, to the lackluster performance of Lyft and Uber in the public markets. Obviously the reasons for that, but I think that's a great lesson. How do you demonstrate like what is seemingly low margin? How can you sort of justify high margins at scale?
Yeah, I think the blitzscaling was the book, was the idea were most popular a couple years ago. When you think about businesses like Airbnb, you can get away with it, but in sort of the WeWork era, or as these businesses become more hybrid, perhaps blitzscaling, as was outlined in the book, becomes a bit more challenging.
Yeah, I mean, blitzscaling works if you're in a highly network effect company, strong network effect company with software type margins. But it's killed many companies as well. And the flip side has been that I think COVID has been a blessing for many companies, that they've actually realized that they focus on growth at the expense of unit profitability, and then they've come out of that realizing, okay, we can afford to take a hit on growth. And Airbnb is sort of, I've not read through their S1 today, but I think this is the classic where they focus on growth at the expense of profitability. And now they said, okay, we have a sort of a pass here. We can actually sort of right size our margins. And now they're kind of, and I see this with a number of companies in our portfolio, that they've focused on efficiency through necessity, and they've managed to get significant growth at much lower cost by just building a product and being more thoughtful about it.
Totally. Max, could you ask your question?
Sure. Thanks, Erik. Hey, Pete.
Hey, Max.
Among other differentiators, NFX is a masterclass in the use of content to build reputation and deal flow. How should angel investors think about the use of content in terms of reputation or brand building? Is a blog post a month on a particular topic the right way to go for angel investors?
The way that we think about things in NFX is both, I think about it as partly as sort of like, what is the sort of air game and what is the ground game? Meaning like, okay, we think about a lot of sort of content marketing to build awareness. And we thought about a lot about kind of one-to-one connectivity to sort of build relationships. And we think about that, both of those as sort of equally important. I'd say on the sort of content piece, obviously, and this is general B2B marketing stuff, whether you're kind of selling a SaaS tool or whether you're kind of selling capital, I would, the same sort of principles would apply. So clearly sort of outcomes is a function of three ingredients. It's distribution, the content, and conversion. So like you've got to think about what is the, and I break this down. So on the distribution side of things, where can you get or where have you got a large audience? And so what is it, and figuring out how you can scale your audience, and, whether you have a pre-existing audience or you have a sort of a database, or whether you need to leverage social platforms or something. And I think that's the sort of starting point, focusing on the audience side. The second piece is content in terms of, I think there are kind of many very successful thought leaders in venture that blog very infrequently, but it's incredibly high quality and incredibly long form. And that's, and some of them do it on audio, some of them do it on newsletters, someone do it on blog posts. So like, I think you kind of have to pick a medium that's appropriate for what you want to focus on and what you feel comfortable focusing on. And then the third piece is conversion. If you're not doing those, but you're not getting outcomes out of it, like how can you think about sort of content that sort of is converting to the message that you want and driving engagement? So I guess I would think about it in those sort of three different buckets: distribution, content, and conversion. And really, trying to get as deep as possible in each of them. I think for kind of us at NFX, we think, we've experimented with videos and blog posts and Twitter and audio. And I think we're going to do all of them. And so we're not sort of stuck on any single one. The one thing I would say, that frequency generally beats quality, which is not to say that quality is not important, but at the margin, frequency, because so much of being a successful, being a venture investor is being front of mind. And so if you have someone who is interested in raising, are they going to reach out to Erik? You need to be front of mind. So at the, high quality and high frequency, yes. But if you have to make a trade-off, I would go for frequency.
Thanks, Pete.
Thanks, Max. Zach, could you ask your question?
Sure. Thanks, Erik, and thanks, Pete, for joining us this week. My question goes back to evaluating seed and Series A deals. I know that you mentioned a heavy focus on team and market, and a lot of investors, when they look at markets, just kind of evaluate it on the pretenses of large and growing. So to double click on market evaluation, how would you think about evaluating markets as a founder and then also as an angel or as a VC? such that we can kind of think of this in a better way than just large and growing?
Yeah. Well, I guess I'd sort of rephrase it. It's like less about the size of the market, which is it's what is the size of the problem. And so I think that's, obviously, and that's the sort of classic, you go back into those kind of seed decks for Uber, like the size of the market's very small, but the size of the problem is enormous. And so that, and I think as an investor, I'm always trying to think about the size of the problem, not the size of the pre-existing solution. And then part of that is the ability to kind of crack that market. And you may have a very large pre-existing market, but it's just incredibly difficult to crack. What's very interesting right now is that, time and time again, as a student of kind of marketplaces and consumer businesses, you've seen market dislocations create imbalance. And where you see, and particularly if you have the sort of classic observation is that where you have pre-existing demand and a sort of a market shock that could enable with technology more supply to be added into the market, that creates a wealth of opportunity. And that's, I was been speaking at an event last week around property and real estate, and you saw a bunch of companies do extremely well in 2008, where there was a bunch of investors wanting to invest in real estate, and they bought up a bunch of foreclosed houses and literally made billions out of that. Similarly today in real estate, where you've got this bunch of demand, can you use technology to kind of bring in a bunch of supply and open up that supply and unlock that supply that perhaps wasn't there? Again, whether does that mean converting offices into condos? Like possibly, does that, could it mean sort of turning strip malls into something else? Like, I don't know, but our real estate is changing dramatically. And so that creates a bunch of opportunity. So it's not only the size of the market, but the sort of how easy it is to penetrate. And within that, it's often, looking at the decision-making set within that. Are you selling to enterprises versus mid-market versus SMB? Typically it's just much easier to sell to smaller customers because there's less decision makers. So, if you're able to just, build up, it's classic bottoms up SaaS, are you able to kind of focus in on smaller customers to be able to sort of demonstrate, who generally have kind of less requirements on the product, and then use that as a path to scale up, then that's clearly attractive as well.
Thank you. That's helpful.
Awesome. I'd like to take the opportunity. We actually have David Booth, the CEO of OnDeck, who's in the room as well, and as well as some other OnDeck team members. And I'd like to take the opportunity, Pete, to just get your investor perspective on OnDeck, the business, in front of everybody, or even at the very least, the questions that you'd be asking to see, hey, is this a venture scale type opportunity at Series A? Maybe David can share 1 or 2 minutes as sort of a high level. Pete, obviously you're familiar that we're, in multiple categories: founder, angels, writers, podcasts, and we're building a market network, to use the NFX terminology. David, do you want to have a bit of an introduction, and then Pete can fire away some questions, and this could be a fun interactive activity for the group?
I think about OnDeck in 4 eras, I suppose. We're in the second, transition into the third. The second was establish a single flywheel. It was the founder fellowship, and create a community that people initially really want to be a part of because it's truly valuable, but also has status associated with being in there and referring others into there. The participation in that community continues to drive that flywheel, encourages people to refer more into it. As the alumni grows, it sort of has a linear growth. We then started to identify some areas where to really create the value for individuals in that community, we needed more than just what could be served by that small group, but the liquidity that comes with a marketplace. And so we said, well, great, let's build new programs that bootstrap the supply to the demand of the founder fellowship. ODA was the first. ODW, OD50 is the one for joiners. And in each of these cases, they are themselves really valuable communities to join and be a part of for that one purpose. But you think about the input to each one ideally comes from another existing community. And OD50's case is a really good example. What do job seekers want? They want jobs. What does ODF want? They want talent. And so that's the third area, is sort of the interlocking network of opportunities, each serving each other's interests. The fourth to me is to say we'll actually take the on-deck directory as the backbone of all of these, and to call that the identity layer that helps people transact through each other. If you want to build your reputation within the on-deck universe as a founder, a writer, an angel, you'll keep your profile up to date because that's the way that we can generate the most relevant introductions for you. You stand the best chance effectively of finding counterparties to your transaction, and there is so much value bundled into that obviously people are paying up front to be a part of this community, and I think that's really important that we're aligning their interests with it. But over time, there's the opportunity to flip on sort of a premium layer of a subscription that actually drives the engagement even further. So people are paying for ongoing access to the full suite of the content libraries, to the premium search tools or something like that, and that's the fourth phase. And that if there was an opportunity to drive a wedge into LinkedIn today, it would be starting out by targeting the most valuable subset of the economy, which to me is the builders and the people who want to work with them and invest in them. And it would start out by creating a space for them to transition a lot of their identity into a digital form and to transact through that digital identity.
Yeah.
You guys are busy.
Yeah. And the thing I just add really quick to that is I'm not a big believer in bank like I always want the first idea you pursue to be the big idea. And so we think we can get to 100 million in revenue just based off the phase that we're in right now, which is expanding fellowships. The founder fellowship itself is a $5 million annual business, and we think we could get to somewhere between 30 to 50 fellowships, and 100,000 fellows paying at least $2,000 a year. So that's how we think about it.
I mean, look, I think it's hard to kind of give you sort of feedback on the spot, but I mean, clearly as a sort of, as a student and practitioner of network effects, there's like clear kind of utility in here. The flip side is obviously the sort of element of kind of like anti-network effects. We've all seen it where we're kind of in a dinner party of kind of 7 people and it's been awesome. And then, it becomes like 20 people and you're like, it's not that much better. Arguably it's worse because there's, 7 conversations going on. And the food doesn't arrive at time, and someone's finishing their appetizer when someone has finished the dessert. And so you kind of, I think that's, that will be the kind of thing to kind of navigate that this stuff, what's to stop other people creating the on deck of X. And so, often the way the companies get over that is just creating a sort of technology platform that kind of creates a more efficient matching algorithm, and kind of so you can curate more effectively at scale. Which I think is interesting. I think the other question, which just goes more broadly to kind of venture businesses and venture capital investing, is like, should this be a venture capital backed company? Do you need rocket fuel? And I think there was like all of us, we're speaking to startups every day. Like, if it's do you need to spend like $10 million building out technology or sales or whatever? Like, maybe not. And I think there's a lot of so I would ask that question first, and we've all met friends that want to raise venture capital because they kind of like think they should, but that's a kind of like the fundamental question. Because I think if you don't have to, then you serve less masters, and that means you can serve your primary audience more effectively. But if you need, if you feel that there is a need to kind of build this out, then you should absolutely do that. I think the other, within this, the questions I would also ask is just around the sort of core product and technology that's there. I think that if you can build out an amazing technology platform, then I think that's, that's really interesting, right? So like, and I think there's a lot of legacy technology, particularly LinkedIn, in this area. But I also wouldn't approach this as LinkedIn, I think, is undisruptable. But I think LinkedIn is very augmentable in that you're able to kind of build value on top of it. Just like Google is undisruptible, Facebook's undisruptible, Twitter. But you're able to kind of like, there are parallel experiences that you can build on top of it in the near term that might actually make it just frankly less relevant in the future. So I would think about it more, how do you make it augmentable? Okay, this is an alternative way to use it as opposed to a substitute.
I just actually have in front of me a quote I actually wrote down off of an NFX podcast with Eugene Wee. which I think is perfect here and sort of framed as a question afterwards. But the quote was, in the long run, the ideal is to be able to offer utility to your user base. It's the most stable long-term competitive advantage you can have in a network. However, it's also true that most network-based utility is only realized at a particular scale. And that's LinkedIn's thing that 500 million users, that's a scale which I think you're right, makes it hard to disrupt. So the question is, how do you get there? Because there's a million networks to die along the way. What's the status game? One thing that we think about is so there is this idea of a trade-off somewhat of status and utility. Nobody looks at a LinkedIn profile and says, wow, you've got a LinkedIn profile. That's it's not a credential. Everyone has a LinkedIn profile. Almost only 1,300 people in the world have an on-deck profile. And it's very hard to get into. We accept less than 10% of people who apply to ODF. And as the community grows, we're still accepting a very small number of people. But there's I know Erik frames this sort of question better than I think, but there's an argument that if we just let 10,000 people into the cohort, so long as you kept the quality above a minimum bar and you set the expectations right, then you'd really only continue to increase the utility through the network value. But we're choosing not to. We're choosing to keep each cohort very small and to sort of to have the community size grow incrementally, and then also sort of to grow on the different vectors. I wonder if you have any feedback on that, Erik. Feel free to reframe that question or that statement if you prefer.
It's this classic problem of moving from a product to a platform, and I think this has been sort of whether many companies have gone through this transition, and most of them will kind of go through it in an agonizing way, because you'll end up having to turn specific features into generalized features, because you kind of have to generalize what you do to kind of help to scale it out into different areas. Whether you're Slack or whether you're Facebook or whether you're Twitter, they've all gone through these growing pains of transitioning from a kind of single product to a multi-platform. So I guess I would be, within that transition, you kind of have to have the stomach to kind of go through it, because you're going to lose people to gain more people, but that's going to be the transition you're going to make, and people are going to complain about it. But I think it requires this level of long-term thinking and sort of product genius to make that transition. I did a podcast with April Underwood. You should perhaps listen to that as well, where she kind of talked about the Slack kind of evolution from product to platform. And she was at Twitter before that, just these growing pains of, and this is one of the real challenges of community-based products, where you try to be utilitarian in terms of kind of listening to the audience and building products that meet their needs. But you also need to be pretty long-term thinking and sort of upset some people on the way to realize that, okay, this is actually better. The Facebook newsfeed is sort of a classic example. Everyone hated it, and then everyone loved it within about a week. But people will sort of complain about, and YC is another one where they were pretty good, 50 people per cohort, and then really bad, 50 to 150. And I think now is sort of, well, who knows? Now it's different. But I think now they've kind of settled into a kind of a better place, because they needed to re-architecture things along the way. But those growing pains are going to be pretty painful.
I just found the podcast. Thank you for the tip. I'll definitely listen to that. I wonder if is there any parallel here you could draw to the way that some information networks have scaled. If I think of examples like Quora or Wikipedia or Reddit or Yelp, they all have a sort of like there's like an 80-20 rule, where 20% of the people create 80% of the content. And in order to kickstart that flywheel of high value contributors, they create status games for them, like the Yelp Insiders Club or the Wikipedia contributors, or in this. I mean, if we take sort of our early engaged super community, I see Max Greenwald's name popping up in the chat. He's one of them here on his second fellowship, and say, have you seen examples of like early communities that can really look after communities that can really look after their early members, and sort of elevate them into super curators or other resources to transition that gap? Or any advice on that front?
Well, I think that's pandering, I guess, or sort of understanding or kind of super users is fundamental, because there is, there's very much this power law, whether it's the Twitter tools for celebrities, or whether it's, like the sort of LinkedIn influencers. So I think all those sort of techniques are kind of very interesting. How do you continue to add more value to the people that are most valuable to you? And part of that is a status component, but I think a lot of it is also utility as well. So the question, perhaps figuring out what is your top 10% of your 1,300 people, and like, what are the needs of that community that you can super serve, and focusing in that. And that may unlock some ideas. Because I think I've heard you talk about it before, you talked about this sort of percolation, often in sort of network business, they percolate out as opposed to plant flags. It's very hard to plant flags. They need to percolate out. So what are the sort of services that this top 130 people are interested that you could provide?
That's super helpful. And in terms of whether to raise or not, it's interesting. It's a heavy cash flow business, so we don't need to scale. I think the space is heating up a little bit, and the combination of COVID also, we're wondering if there's a bit of a land grab opportunity, and then also just a higher valuation allows you to acquire people or acqui-hire people, and convince them their equity is worth more, or tell them their equity is worth more. And we see a lot of people who are doing on deck for X who we want to do that in our site.
Yeah.
So those are some reasons why we're considering it.
Yeah, I mean, at the macro level, like education is ripe for disruption.
Shahrose has a question. I'd like to call on her.
As you think about how we're transitioning from like maybe the 1.0 or 2.0 version of marketplaces, where I think in many of them, maybe one side is served better than the other, supply versus demand. Often, you think of the Uber example, the supply side might not be as happy as the demand side, or to your point on LinkedIn, I don't know that as a consumer, I'm that happy with the product, but supply is there. All the jobs are there if I'm looking for one. But also the margins have been a challenge in this business. So as you move into the new world of marketplaces, like what do you imagine will be different in the next wave?
Well, I mean, I think if you look at the sort of fundamentals of how marketplaces have evolved, they've really evolved in two directions. And this is sort of it's the drumbeat of marketplaces. Now, I would say it's like, and so the axis is like, on the one hand, it's improving the user experience. On the other hand is creating more value or extracting more value from the transaction. And that's just the drumbeat, constant drumbeat. And I think you've seen how different marketplaces have entered that universe. So take DoorDash example. Like there are a lot of companies who are doing restaurant delivery, but Uber was owning the experience and was able to provide literally a better consumer experience, actually take less money, but over time, they clearly are able to take way more money. So that I would say just the constant drumbeat of how do you have a better user experience or extract more money from that transaction. The better user experience can obviously drive to kind of better supply side, better demand side acquisition. But if you have greater unit economics, then you're often able to have more money to spend on acquisition, have more money to spend on product development. Or even sort of get vertically integrate, so-called managed marketplaces, if you're able to capture more of the transactions. So that's the sort of simple area. And then there's often, whether that's consumer demand changes or whether that's technology changes that enable, which unlock kind of new sort of category shifts in these pre-existing marketplaces. So, whether that is I don't know, I'll make it up, but like VR becomes a thing and you're able to, transform the economics of a particular industry and as such create a new marketplace based off VR. Those technology shifts are often catalyzing events to create new experiences.
When you think about particularly the margin question there, just to like dig in on that for just a second, like, yes. So if you think about a constant drumbeat around better user experience, are you implying then, raising prices to then increase those margins to extract more money? Or is there another way to really think about the thin margins that we're working with? Or is it really just about getting to that scale?
Well, I'm thinking more about better user experience broadly. and I think this is sort of a mainstay of like, okay, let's take some examples, whether that is Airbnb. Like previous to Airbnb, Home Away just didn't give you kind of immediate booking, which was kind of lame. So that, and that was a sort of simple innovation that Airbnb had that enabled them to kind of create a better user experience. In real estate, Open Door, I think if you can sort of get cash in 48 hours for a property, like that's a great user experience. But I think you kind of, I wouldn't think about sort of incremental user experiences for breakthrough marketplaces. It's like, okay, how do you have a like 5 to 10x better user experience that you're able to build that will kind of create a like, give the ability to suck the kind of like the supply or the demand from a previous existing incumbent marketplace over to this new marketplace. And it may be in this sort of tiny niche that you could use as a wedge to kind of open up into a much bigger market at time, which is exactly the case with Airbnb back in the day.
Great. Thank you.
Awesome. Thank you, Shara Rose. I think that's a great place to wrap. Pete, thank you so much for taking the time to chat with us about angel investing and about your experience at NFX. This has been a fascinating conversation. We'll really appreciate it.
Cool.
If you're an early stage entrepreneur, we'd love to hear from you. Check us out at villageglobal.vc.